quality improvements. And it looks from this chart that the improvements in operations and quality will be completely eliminated by the increase in SG&A and R&D, which means technically that your entire operational improvements and margin improvements will have to be driven by volume, price, and mix. Can you describe exactly what you're going to do to increase volume, price, and mix, given your geographic exposure, your underrepresentation in growth regions, et cetera, et cetera? I mean, this just highlights the importance of volume, I think. So a little bit more deep dive there, please.
Sure. I couldn't catch the first part of your question due to technical issues, but I think I know where you're heading. Our top-line growth is underpinned, as it has proven now already in the current year 2022, despite chip shortages, by a continued market share gain in our heavy-duty business, as well as a strong light commercial vehicle business picking up. And we are strong in light with north of 12-13% market share, and in the heavy side also growing. In that sense, top line is 75% of our business is Europe, and we are well positioned to further grow, not only in the more, let's say, northern parts of Europe, but also in the southern parts of Europe and eastern parts with our partnership with Autocar, which gives us a very competitive partner product in the city and urban transport solutions. So there is a good thrust of top line, plus we have FPT Industrial with a strong third-party business clocking orders and clocking new customers as we speak. So there is a strong top line. But I think your conclusion that the improvements from the DRIVE program are entirely covered or consumed by SG&A and R&D, I must admit the SG&A today is at very low levels, and in percent of top line is shrinking even further. While in R&D we have to invest, that's for sure. Okay,
that's helpful. And just to follow up, as I'm listening to your presentation, I apologize if this is the cynic in me, but the notion that you are a nimble and lean organization strikes me as a little bit odd. I mean, if I look at your organization structure, it's probably the most complex in our coverage with your filing in the Netherlands, you trade in Italy, your management's headquartered in the UK. Any plans to simplify all of that? And then, example after example, like the filing of the recent paperwork, you've already reported Q3, yet your filings only include the first half of the year. I mean, can you give examples of where you believe you are lean and nimble? Thank you, and I'll get back in line.
Sure. 6.5% SG&A of sales is fairly lean and nimble, I would say. And the structures that we have put in place are purpose-built and certainly serve the purpose we aim for.
Thank you. As a reminder, it's *1 for a question. The next is from the line of Monica Bosio from Intesa Sanpaolo. Please go ahead.
Yes, good afternoon, and thank you for taking my questions. The first one is on the services area. I don't know if you can share this, but what kind of margins can we figure out for this business? And what is your optimal weight of this business on the total industrial revenues at a steady state, just to have some flavor on this? And this is the first question, then I will be back.
Oddone.
Well, servicing is definitely an important part of what an OEM does. We are not typically disclosing the revenue distribution between services and whole goods. But there's in the plans you have seen, there's the ambition to grow servicing, both in what we provide and also in the way we provide them, with the pay-per-use concept that Gerrit was explaining before.
You expect a growth above 5%, just to have an idea? Sorry if I insist.
Well, if you mean 5% as a percentage of total revenues, probably not. But definitely will grow more than what the revenues themselves are growing.
Okay, got it. And the second is on powertrain. Can you just give us some flavor on the evolution of your non-captive business? Just a target, if it's possible, by 2026. Thank you very much.
Yeah, I would like to hand this question to Annalisa.
Yeah, thank you for the question. The ambition in the plan is very clear. We continue to have as a main goal for powertrain to be a player independent in the market. We are going to have an higher percentage of non-captive customer in our portfolio, and we have a plan in place already of booking of customers in order to achieve this plan. As you can imagine, our kind of business is a long-term business, relationship-based, and we are really in a good shape in order to achieve the target that we have in our plan in order to succeed on that.
Okay, thank you very much. Just a follow-up. Can we imagine a back-end loaded plan in terms of increase of the non-captive business as for powertrain?
Yes, the answer is yes, of course.
Okay, thank you very much.
Thank you. The next question is from the line of Daniela Costa from Goldman Sachs. Please go ahead.
Hi, good morning or good afternoon. I have two questions, but actually one follow-up first, because I might not have understood the number you said towards the percentage of service in your sales to the prior question. So just a clarification there. And then my two questions. First, can you comment in terms of like your penetration pace that you see for new technologies, like for the EVs and the fuel cells, just to also understand how that impacts basically your margin guidance? Do you see those technologies being lower or higher margin than internal combustion engine? And then the second question, can you comment a little bit in terms of how management compensation will be set and kind of the timeline for the targets and weight of various targets? Thank you.
So as a percentage of sales, as a matter of fact, I haven't said a number, which we are typically not disclosing. What we said is that we expect sales to grow more, sales for services to grow more than the overall growth in sales that we have in the plan.
Thank you. So you do not disclose the number. I guess
No.
that we look at peers as a proxy, or because I think most of your peers do disclose.
Yeah, but also because our revenues, we have revenues for the vehicular business, which typically have high service component in there. And we have revenues for our engine business where we are developing service components, but they are by nature lower in percentages. So comparing with a pure truck manufacturer probably will not be significant.
Okay, thank you.
And I think the second question was about penetration rates of battery, electric, and fuel cells. Marco?
Yeah, I can take this one. I mean, this is strongly depending on other factors as well, such as the rollout of the infrastructure. We expect in some areas where there is already an OPEX and CAPEX subsidies, such as bus, we're going to achieve a parity much earlier. We have already some use cases where there is parity today. For the other ranges, we expect that this is going to happen in the second part of the decade, once we are going to experience the rollout of the infrastructure.
And on profitability of those
we are not
areas versus, I think.
Sorry. We are not planning a reduction in profitability. I mean, in the beginning, we are going to keep the same level of profitability, meaning that the profitability is going to follow the same increase in profitability of diesel. We expect to offer a long-term sustainable and connected transport solution, meaning that the interaction of green technology plus the connected and autonomous driving is going to open new possibilities in increasing profitability.
Thank you.
And the question on management compensation?
So from the position of the board, we haven't yet set the details of the management compensation, but we will be doing that, and we will be confirming it once the new Iveco board is appointed at the point of the spin. But as Gerrit made clear, and as I made clear in our introduction, we will both be targeting the management very, very clearly on the delivery of the plan, and we will be including ESG metrics in that compensation. And we will be including in it elements of both obviously short-term compensation, an STI scheme, and there will be an LTI scheme within that as well. We do believe that compensating management for the performance and for the delivery of the plan is important, and it's also very important to align that with what shareholders would like to see.
Thank you.
Thank you. The next question is from the line of Martino De Ambrogi from Equita SIM. Please go ahead.
Thank you. Good morning. Good afternoon, everybody. The first question is on the financial structure. You're starting with a net cash position, which is quite clear the reason why. But you are also projecting further free cash flow over the next few years. So considering you will not distribute any dividend based on your prospectus this year, we will know what is your payout going forward. But should we expect the cash to stay in your account because as a way of protection to preserve the investment grade, or can we speculate on some different use? Thank you.
Martino, we had on our presentation, we have on the prospectus that we won't be paying any dividend in the first 12 months of operation of the company, but then we have allocated money for paying dividends in the future to start with. Then we have an ambitious investment plan, and then we have, definitely we will start with a net cash position. We intend to preserve a net cash position over time. But this business has a seasonality in itself and has a cyclicality. So we want to have a strong capital structure for the business to start with, but also during the year. So expect a relatively high level of liquidity to be there to support the business over time.
Okay, thank you. And the second question is something we already discussed in the past, but as Suzanne mentioned in the introductory remarks, you confirm you received an offer some months ago, but you prefer to choose the separate listing. However, if we look at your competitors, you are less global than your competitors from a geographical standpoint. So how do you plan to solve such an issue going forward in order to become a long-term, to provide more visibility long-term and not be too exposed to Europe?
I can take the geographic exposure. One of the partnership purposes that we have is obviously that we expand those also on the geographical presence. We, for example, I mean, this is one angle, but the whole Nikola partnership also comes with some indirect exposure to the North American market. And we were very clear during our 2019 Capital Markets Day that we are in discussions and seek for partnerships that will open up other geographies and territories which we cannot enter on our own alone at this point in time. But we are fairly confident that our size we have in Europe is sufficient for greatness and for the endeavors we have ahead of us. Plus, just having a certain size doesn't mean that let's say the potential you have to invest is invested necessarily as efficient than we can do at smaller scale. So I think scale is something that is on our side sufficient. We certainly look for partnerships in technology areas and geographical expansion. And overall, we are pretty confident that over the next couple of years, we're going to balance this through and balance this out on the global scale.
Thank you, Gerrit. Just a follow-up. When we talk about partnership, are you ruling out any potential merger?
The nature of partnership discussions is to rule nothing out in the beginning and explore opportunities and perspectives that are mutually beneficial. But as Suzanne laid out, the spin-off and the independence of the Iveco Group is the cornerstone to start with, and everything else will be subsequent to it.
Thank you. Thank you.
Thank you. The next question is from Jose Asumendi from JP Morgan. Please go ahead.
Thank you, Jose from JP Morgan. A couple of questions, please. Can you talk a little bit as you electrify your truck, bus, van business? Which components will you produce in-house, like the electric motor? Is this going to be development in-house? And can you share components across all size vehicles, just to understand a little bit the economies of scale, or will this be outsourced to suppliers? Second, can you talk about the powertrain FPT business? Is there anything on the industrial side you can do in terms of fixed cost reduction? How do you improve the profitability? Can you maybe help us understand a little bit the top line growth for the coming years? And then final one on heavy duty and in Europe. I mean, it's a great business, but it's slightly subscale versus your peers. Is there anything else you can do on heavy duty to improve the profitability? Is it either pricing or anything on the fixed cost side that you can do to improve the profitability? Thank you.
Thank you, Jose. I suggest, Marco, you take the point on the electrification with the components. Annalisa, if you take the powertrain fixed cost, and I take the last one on heavy.
Yep. So starting from the electrification, well, the answer is yes. I mean, on the new eDaily platform that we are going to launch at the end of next year, we developed the product inside. In terms of component, the battery is going to be, in terms of module and pack, internal. There is a partnership with the Microvast. In terms of eDrive, is going to be an internal project where FPT is very active in the axle development, not only for light range, but also for medium and heavy range. In terms of synergies, absolutely yes. In 2023, we are going to launch a new generation of e-bus that is going to utilize a very similar battery, meaning that the same technology can be applied in different product lines. And when we come to software and controls, that is a very important part on electrified vehicle, absolutely there is a synergy across the different ranges, so in line on the maximization of the efficiency and investment.
Lisa, on fixed cost?
Yes.
FPT?
Yes, I think that probably the best answer to your question is the way in which we exercise during the pandemic period on how our plants are resilient to the fixed cost. We made an analysis on the whole footprint, and we arrived to a point in which our plants are with the capacity that is capable not only to answer to the current demand of our customer, but as well to acquire opportunities in terms of future partnership or to acquire additional business, as I mentioned before, that is in the plan for our growth. We are transforming our plant as well as the plants of Iveco vehicle side, because we are transforming from a pure traditional industrial combustion engine to the new products that Marco just mentioned in his answer. So we are really in a good shape, and we have no risk at this point in time that cost fix will determine a deterioration of our margin.
And Jose, I take the third question about heavy duty. We are coming from a tough territory in heavy duty back in 2018. And we have managed to significantly increase our market shares from being Europe's last now to be around 7.5 plus 8% market share in heavy duty trucks, which is on the rise. And as I mentioned, we have still the X-Way and the T-Way programs to fully exploit, which is in the making. So it's launched, and these successes are going to come. But as you rightfully say, there are multiple ways to increase profitability. When we look at electrified and fuel cell heavy-duty trucks, the pay-per-use model obviously is a very interesting subscription-like business model that comes with a full package of services and is going to provide an umbrella under which these vehicles, these electric heavy-duty trucks that are between 3 and 4 times more expensive than a diesel truck, can operate as profitably, if not more profitable, than our current lineup. So we are pretty confident that this path is going to continue. And in heavy-duty, it takes time. Holding periods are about 5 years, 4, 5, 6 years in customers, and changes take time until they show. Yeah? So therefore, we are confident that the plan will deliver this. It takes time, and step by step, we're going to improve across the entire lineup and range of alternative propulsion fuels as well.
Thank you. The next question is from the line of François Robillard from Intermonte SIM. Please go ahead.
Hi, everyone. Good afternoon, and thank you for taking my question. First one is still on slide 42, where you give the breakdown of your future margin improvement targets. I see that although you see the short-term supply chain and price increases in raw materials leveling up, by 2022, you still include it in your mid to long-term targets. I guess part of it is offset by the volume and by the pricing increases. Just can you give back some more color on that? And second question, apart from the obvious pandemic answer, how come your targets differ so much from what you presented back in 2019 in terms of adjusted EBIT margin? At the time, you were planning to reach 7% for CSV and 10% for powertrain by 2024. Can you just give us a bit more of color on what differentiates the targets you did back then to what you provided today? Thank you.
Yes, of course, François. We expect the semiconductor shortage and the related supply chain disruptions, as well as continuously increasing raw material prices, to somewhat peak and then more normalize throughout the year 2022. And growing volumes, and we've commented on this during our third quarter earnings calls, we have order books right now which are north of 30 weeks, 35 weeks in some of our plants, which is a coverage well into next year. And volumes are there. Market is quite strong at the moment, and we do see that momentum coming to fruition in the year 2022, offsetting those headwinds. On the targets that we presented back in September 2019 in New York at the Capital Markets Day there, in between 2019 and today, there was a new European Commission. There is Fit for 55, right so. Programs in place for alternative propulsion, zero emission, carbon neutrality. There has been a decision on a Euro 7 emission regulation as well. And there are multiple other, chances and opportunities for us to capture with R&D and investments. So in between the 2019, we have seen much more of those coming our way, which on the one side are great opportunities to capture and make things quicker and faster in the way how we operate, but also they require spending. So therefore we are prudent, and we have put forward here a very realistic plan with achievable targets that we believe is a solid foundation we can build and on further stretch as we move through the plan and deliver quarter by quarter.
Thank you very much.
Thank you. Our last question from today comes from the line of Alexandre Raverdy from Kepler Cheuvreux. Please go ahead.
Yes, good afternoon. Thank you for taking my question. I will have a question on the zero emission strategy in heavy duty trucks, please. You have so far focused on natural gas trucks, but when I look at the data from the European Environment Agency on CO2 emissions, I noticed that Iveco has actually higher than average emissions across almost all segments, despite having a large share of natural gas trucks. So this looks a bit counterintuitive to me. So first question would be, how do you explain this? And the second would be, do you still believe that natural gas is actually one of the relevant technologies to reach the CO2 targets you have for 2025 and 2030? Thank you.
Thank you, Alexandre. Marco?
Yep. Yes, natural gas is one of the strategic pillars that we will pursue for the future when we think about a net zero carbon solution, because as Gerrit was presenting during the presentation, is really the only available net zero carbon solution with a TCO that is comparable to diesel. We believe that in the idea of circularity, natural gas will play a key role. We will still working on improving efficiency of internal combustion engine, because especially on the air-to-abate sectors, internal combustion with improved efficiency, running a renewable fuel will play a role in the decarbonization. But at the same time, we are on the road and accelerating the introduction of zero-emission vehicles tailpipe. We are going to introduce a new e-daily at the end of 2022. We are going to expand our electrified lineup for buses, where today we are one of the top players. And in 2023, between 2023 and 2024, we are going to be among the first to introduce battery electric and fuel cell for heavy-duty trucks in Europe. We believe that, especially in heavy truck, we will see a set of technology for this decarbonization trajectory. And I think that with this intervention, we will be among the best players in the market to offer all these solutions together.
And Alexandra, let me add one more point. You referred to tailpipe, and as I tried to be explicit in the presentation, is climate change is the result of circular processes not adding up anymore. In fact, they are actually increasing the CO2 emissions in the atmosphere. When Marco talks about, or we talk about biomethane, renewable fuels, also liquid fuels, this is actually carbon neutral, almost carbon neutral when this comes from renewable sources. And so the loop is actually close to zero. While counting the tailpipe, it's only minus 10 to 15% versus diesel. So I think this is an important shift in perspective when looking at emissions. What counts is the end-to-end, well-to-wheel view at energy consumption and emissions, because tailpipe alone is not going to solve this climate challenge.
That's very clear. Thank you very much.
Thank you. That concludes the conference. I will hand back over to the CEO, Gerrit Marx, for final remarks.
Thank you very much for joining us here today once more, and also thank you for your challenging questions, and I'm sure in the next events and the next interactions there will be more. And this is good because it triggers and pushes us to get better, to move, to innovate, to recreate, and to come up with new answers to the questions that our generation has to face. And I think you have met today a part of this fearless and creative team, and we will show other members and present other members and their ideas to you in the next Technology Day event that is coming up in Turin in the first week of February. Thank you very much for your attendance. Have a good day.